All right, Win. So now we're talking about asset versus stock sale, and this is something that a lot of sellers are really curious about because they're just trying to figure out what's the best option for them. Then, of course, the buyers wanting to know what makes the most sense for them. So talk us through a little bit about what that is and why that's important.
Absolutely. So in a business acquisition, of course, everybody know that there's an asset sale versus a stock sales. With asset sale, what it is that the buyer come in and they acquire assets from the sellers. They're not acquiring 100% of the company. They acquire assets such as inventory, customer lists, equipment, and all those things, right? So on an asset sale, what it does is it's more favorable for the buyer themselves. Because with the buyer, when they acquire asset, they will be able to receive the step up in basis with all of the asset that they acquire from the sellers. Therefore, they will be able to increase the depreciations, and also an important part of that is the goodwill that will be allocated to the deal as well. Right. With goodwill, the IRS allow you to amortize goodwill over 15 years. So that creates an additional deduction for the buyer in the first year of operating after they acquire the business that help reduce the tax liability a little bit right there. But for the sales side, for the seller, with an asset sale, they potentially, it's less favorable for them a little bit in the sense that because the only thing that they sell is actually the asset of their business. The business itself, the entity is still intact and everything like that. They will have to pay capital gain on each of those assets that they sell, right? And inventory eventually can be taxed as ordinary rate because that's inventory. And also, in order for them to actually stop the business itself, they have to dissolve the entity themselves. So it's more so, and also the buyer, they can actually pick certain asset. It protects the buyer more in an asset sale in the sense that because they only purchase the asset, the liability and everything like that can stay with the seller, right? So that is something that a business owner, especially those looking to either sell the business or buy a business, need to pay attention to. The next one that we have, of course, on the other side is a stock sales. Now a stock sale, what is a stock sale? So a stock sale is when a seller sells 100% of their ownership of that entity. Right. The buyer come in, instead of buying the asset, they actually acquire the entire company, meaning acquire its asset, liability, and all those in between. With those, for the buyer, they are not eligible for the step up in basis. The entity basically just continue at its normal operating activity along with like normal depreciation and everything like that. The only thing that changed is the owner name. That's essentially it. So therefore, they do not have the goodwill, or a little goodwill will be allocated, or they will not have the step up in basis as well. For the seller, this is a cleaner transition because basically you just you just sell the whole company. Right. So, and everything with it. So you should walk out of it clean. For the sellers, with the stock sales, it's more favorable because everything will be treated at capital gain, and therefore they are eligible for a much more favorable capital gain rate compared to like ordinary income rate, right? So that is asset versus stock sales.
Okay. So how does that relate to the qualified small business stock that we were talking about previously?
And with the stock sales, of course, one of the things that the seller need to pay attention to is whether or not they actually qualify small business stock. Because if they do, structure it under the stock sales can potentially help them escape all the gain from the sale business, up to $15 million if your stock is issued after July 4th of 2025.
And another thing that I've seen on the stock sale side for the buyer is a lot of times they're able to keep those contracts in place. They're able to keep, any intellectual property that's there. And so it's very beneficial for the buyer as well because they're able to just continue business as usual and they're cash flowing that thing.
Yeah, it's less disruption on the business operating side.
Yeah.
What asset sale, like I said, if you acquire only the asset of that business. So the buyer create another entity that will acquire this entity asset. Right. So that is a little different there between the two.
Yeah. Okay. So last little piece here, we always want to talk about who are the people that are going to be in the room, right? So who needs to be in place as we're looking at an asset sale, stock sale, to just kind of make sure that all of this happens properly.
So with the who do you need help with this? Of course, it's going to be your CPA. Always consult with your CPA, your tax strategist, if you have a CFO or some type of CFO, then talk with them. Make sure that your financials are clean, right? All the assets are in place and everything like that. Also, a business an appraiser, so that you know the fair market value of all of your assets within the business. That those are the professional that should help you navigate through all of this.
And then we also want to make sure, I want to add that we always want to make sure we have a good solid contract or business attorney that's going to be in place, because they're going to be the ones to actually take a look at any contracts that you have outstanding or with vendors or customers or clients or anything, and make sure that everything transitions over smoothly from a documentation standpoint.
Correct.
Of course, they're not going to be the ones that will always advise, okay, hey, you should do an asset sale or you should do a stock sale, but they definitely need to be in the room when it comes to looking over that documentation.
Absolutely, absolutely. Another note that I want to add to asset versus stock sale, of course, there are some special structure out there where you can actually, legally, you structure on paper, you structure the sale as a stock sales. Mm-hmm. But if you are able to make these elections, such as the Section 338 election for a corporation or a Section 336E for individual or for individual and S corp, those can actually help you make a stock sale is treated as a asset sale with the IRS. So it creates kind of like a hybrid structure, right, where on paper it's an actual surrender of the entire company.
Right.
On the tax side, it's a deemed asset sale.
Yeah.
So the buyer get all of those favorable terms like depreciation, goodwill amortization, and all those things.
Right. And one of the things that we always advocate for is starting this process early.
Right.
Right. Not waiting until you're ready to go out the door. 6 months from now, you're ready to sell the business and get out of it, but you always want to make sure that you're starting. We like to see a 3 to 5 year time span. It gives us a longer runway to really get in there and start doing some planning and making sure that we have all the right people in the room so that you can exit on your terms as a business owner and as a founder.
Right. So the earlier you start, the better you prepare for it. And like Jeremy said, what we want to help you with, especially business owner, is we want to help them exit on their term. Whatever that is, transferring that to a legacy to their children, or they actually looking to sell.
Absolutely. All right. Good stuff, Win. Thank you, man.
Thank you.